The two cheapest quality stocks to buy in the stock market. Normally, you can't really combine cheapness and quality. I mean, quality stocks, they tend to trade at a premium for certain reasons, and the cheap stocks, they tend to be cheap because something is wrong with them. But occasionally, some of those quality stocks, they get into a rough patch. Something goes wrong with them. It's normally a temporary problem, but the market and many investors, they get caught up in the story, and they believe that this problem is permanent. So they skip those stocks and some of them even sell them. But many contrarian investors like myself, I don't really follow what the market is telling me. I try to look at the research and I look at what my research is telling me. And many times those problems aren't actually permanent, they're actually temporary. And if you do buy those stocks on a temporary problem and the market wakes up to the fact that it's temporary, you don't only get an amazing growth company at a discount, but you also get a multiple expansion. And the combination of a multiple expansion and earnings growth is very, very rewarding, trust me. It's the upside is insane. But if you're wrong, of course, and it ends up being permanent, then you have to know how to manage it, when to take a loss, when to change your mind. But I'm gonna talk about those stocks today. The first one is a stock that I've been talking about more recently, but I'm going to do my final deep dive on the stock and talk about some of the things that the CEO said on the earnings call. They are pointing that this issue is temporary and not permanent. The second one is a company that had so many requests on doing. I haven't talked about it in a year. It's trading at 11 times earnings with over 50% net income margins. So I hope you enjoy them. And if you do, all I'm asking is please press the like button and let me know what you think in the comments. It would help me very, very much in doing those videos and giving you some ideas. So I hope you enjoy it as always. I'm going to get started with the first one. And this is the most hated one by far. And it's UNH, which is United Healthcare. It's down 30% over the last months, 23% year to date. This is one of the best performing stocks of all time. It's up 142,000%. A lot of the quality investors like the stock as it tends to do well in bad environment, in recessionary environments, inflation, tariffs, whatever. The company is bulletproof on that point. And then many dividend investors love it because the company grows the dividend over the long term. So it was a very respected company prior to 2024, and everyone wanted to own the stock. But right now, not many people want to own the stock. And then the stock, it's kind of performing terribly as of late. And as of the last report, the company has revised their guidance down to 26 and 26.50 versus the prior outlook, which was 29.50 to 30. This is a massive, massive revisions. And the stock has been tanking for over 2 weeks. I don't believe they have seen a green day, maybe 1 or 2 green days, but over the last 3 months, 2 months, it's been terrible for United Healthcare. And the market and many investors tend to believe that those issues are permanent. But the main issues with United Healthcare right now is higher utilization rate with their plans. So some people are using their plans more often than normal, and they have higher Medicare kind of costs, which are affecting their business. But many people believe that whatever happened with the CEO in late 2024 is the reason why this is happening right now. And it's the reason why the problems with UNH aren't actually temporary, but they're permanent. And they believe that the reputation of the company has been ruined. Okay, but if I look at the data is telling me otherwise. If I look at when this unfortunate event has happened, very sad event, it happened on December 4th of 2024. Okay, now if I look at Q1 of 2025, the company has grown in revenues around almost 10%, 10% revenue growth. That's not what you normally see with a company that their reputation has been damaged and all these things. It's still growing revenues massively quarter on quarter by almost $10 billion in revenue growth. If I look at the total users at United Healthcare actually grew in members by over 700,000 from 50.7 million to 51.3 million. Optum still has 99 million members. So if this event has caused such a massive, ruined the reputation of United Healthcare, then people would be leaving United Healthcare, they wouldn't be joining them. But United Healthcare has gained around 600,000 members, and they still expect to grow another 800,000 members in 2025. So I'm not saying the reason that, that this event has caused a permanent damage to UNH reputation. If if it did, then people would have left in Q1, but they're still in Q1. So that's telling me otherwise than what a lot of people are telling me in the comments. But now I'm going to go through some of the things from the earnings transcript, and I'm going to tell you a few things. And again, you have to kind of be a little bit of a contrarian to look into those stocks because they're hated for a reason, and you kind of have to have a different view. But this is what the earnings call said. This is mainly regarding to the higher utilization rate. And it says, first, growth in certain markets where there were meaningful planned exits. These new patients had not been engaged by their prior plans for most of last year. This is very addressable. So they pretty much had expansions in new market. Those markets, they had massive planned exits from other insurers. United Health went over there, and a lot of people signed up for United Healthcare. And those members, they haven't used their plan for over a year and a half. So once they got into United Healthcare, they started using their plan more. It caused utilization rate to spike. This is a temporary problem. It's not a permanent problem. And they said this is very, very addressable. Something else that they said on the call is he said, and we think that a lot of the issues that we're seeing in early 2025, we can fix in 2025 and help us deliver stronger performance for 2026. And we expect that to then be a kind of a ramp into reacquiring our target growth rate momentum that we aspire to as an organization. So they believe most of the problems that are happening right now is mainly because of them. They messed it up a little bit. They believe they can fix it this year, and they believe 2026 is going to be an amazing year for United Health. And the management of United Health have an amazing reputation in terms of being shareholder friendly and fixing those problems, getting through challenges and getting over them. And something else they're saying, they say we are seeing that inside of the first quarter of this year, but we are making the assumption that right now that the trend will persist through 2025, and then also making the same assumption that it will persist into 2026, and that will shape our overall pricing assumptions. So even though the higher utilization rate has a very high likelihood of being temporary, the United Healthcare team is pricing it in like it's going to be permanent, which tells me that there's a lot of upside for a surprise in the estimates, as the guidance of United Health, whenever they lowered it to 26.50, is pricing as the worst case scenario, which means that the utilization rate is going to be the same for all of 2025. Now, if the utilization rate ends up going down or something else changes with the cost structure, then there's massive upside on those estimates. So those estimates are telling me that United Health is priced in on pretty much the worst case scenario in terms of the issues they are facing. Something else they said, that we're committed to improving our performance in the rest of 2025 and into 26. And in doing so, to delivering consistent positive results for you and returning to our long-term earnings per share growth target of 13 to 16% earnings per share growth. Where is the company trading at right now? 14 times earnings, 14 times forward earnings, with the average was around 19 times. Now trading at 14 times earnings, very close to the COVID multiple. The COVID low was at 12 times. And this has historically been an amazing time to be buying UNH. But you're buying UNH on what I believe is the worst case scenario for earnings per share growth, and it's 13 to 16% over the long term. You're buying it at 14 times. This is almost one-time PEG ratio or one-time price to earnings growth. And many investors would have dreamed of buying United Health over the last year or 2 years at 14 times earnings. It was trading at 24 or 25 times. And people were saying, oh, it's a quality company, amazing company. But now it's hated. People don't want it anymore. And to me, I get very interested when I look in those things. If you look at the free cash flow yield, the free cash flow yield is almost 8%. 8% on United Health. If you look at this line I'm about to show you, you could clearly see that many times United Health has spiked to an 8% free cash flow yield, and it hasn't stayed there for long because it was just kind of a bottom, historical bottom in terms of valuation. An 8% free cash flow yield for a company that's growing 10% in revenues, this is cheap. This is not normally happens with a company that's not growing in revenues. It trades at 8 and 10% free cash flow yield, like the tobacco companies and other kind of companies. And something else that the market has forgotten about is that United Health and many of those companies have skyrocketed on April 8th because the Trump administration has signaled a Medicare rate boost for 2026, and they want to give them a boost by $5 0.06%, above the previous bump of 2.23%. So United Health has done decently well under the Biden administration with only a 2.23% bump. Now imagine what double that, more than double, around 5%, is going to do to United Health. And if you combine this 5% that's coming into 2026, and you combine it with the company potentially fixing their problems this year and having a much better year in 2026 and easier on a comp basis from 26 to 25, to me, I'm seeing an amazing setup on a company like United Health. And many of those charts, as I showed you, the total members, I mean, they're staying, they're even coming, they're not actually leaving, which is telling me, and I combine it with everything I showed you from the transcript, it's telling me that the issues for United Health aren't permanent, but they are actually temporary, and they will likely get better from here. It's not going to get worse, but I could always be wrong. And by the way, I'm using FinChat for those kind of charts, and I like them because I couldn't find any company and any kind of website to show me the total number of members and all these kind of things. And if you want to try it out, they give you 2 weeks of free access with my link in the description. So I've been using it a little bit more, and I like it very much. But that's just my opinion on United Health. And I know it's not for everyone, but I mean, I was started as a value investor, and I kind of enjoy looking into things that are hated and having a different opinion from the market. But the second one, which is also a very hated stock, and this one was loved, and I haven't talked about it in a year, so I'm going to talk about it again. And this stock is EVVTY, which is Evolution Gaming. The stock is down 40% over the last year, from almost $120 to $68 per share. Evolution Gaming doesn't trade on you can't buy it on Robinhood or Webull. You have to buy it on OTC, EVVTY, or you have to buy the Swedish exchange if you're interested. But Evolution Gaming is mainly a gaming, you could say, creator, where they make those online games for the online casinos. So if you ever played an online casino on the internet, the game is most likely created by Evolution Gaming. And this is how the business model works. You have the end user, which is whoever is gambling online. Then you have the gaming operator, which is MGM, or even Caesars or any of those casinos, gaming operators. Most of those gaming operators, they don't actually create the games themselves. They rely on companies like Evolution Gaming to create the game for them to make money from it. And the gaming operators, they operate the game. They pay Evolution Gaming variable commissions and fixed fees. It's a very profitable model. And the TAM for this industry is still massive because only 28% of total casinos are online. 72% are still land-based. So there's a massive opportunity to take most of it online over the next few years. If you look at the growth, land-based casinos only grew at a 1% CAGR, but live casino grew at 24.7%. So the growth over here in live casino and mainly online is rapid, and it's only 28%. And I think it should be 40 to 50%. There's a lot of runways in this business. And the company has over a 45% market share in, you could say, online gambling and online gaming in general. 45% market share. And the market share have been going up. It hasn't been going down. From 39%, 41. Now it's estimated to be a 45% share of the market. Now, I showed you all those things, and the company look amazing. And I told you it's trading at 11 times earnings. But why is the stock going down if they have a 45% market share and they have such a moat in a niche industry? Why is the stock going down? The main reason the stock is going down is because of the same reason why Celsius gone down and many of those growth stocks go down, Elf Beauty and others. And this is plummeting, revenue growth. Whenever a company is a growth company and it's growing like Evolution Gaming was growing, once the growth decelerate, the multiple gets a massive contraction. And that's what happened with Evolution Gaming. At one point, it used to trade at 50 and 60 times earnings. Now it's trading at 11 times earnings. But something has happened for the first time ever this quarter, and the company has declined quarter on quarter in terms of revenues. And this is a major step change because since the company went public, they haven't posted a single quarter of declining revenues quarter on quarter. Now, if you look at cash flow, or say operating cash flow, it has actually increased quarter on quarter. It's been holding up very well. They control their expenses, but revenues has declined quarter on quarter, and that was due to many different things. They believe some of it is due to timing of them launching some new games. Some of it was due to some kind of cybersecurity problems. They always have a lot of cybersecurity people trying to, hack some kind of those games and do certain things. That was a major one. But they said, we believe that the actions we are taking will also impact the second quarter, but that the second half of the year will be stronger. So the company is saying that the issues they're facing right now are more of temporary issues than permanent issues, and it could very well be the case. And the company is putting their money where their mouth is, and they're buying back massive amounts of stock, 178,000, 178,000, 200,000 shares, 500,000 shares, 297,000 shares. They're buying back massive amounts of shares, and they're taking shares outstanding down a lot like never before. The company was mainly focused on dividends. They're still doing dividends, but they're now doing more buybacks, and it's really making a big difference in the company, and it's going to reward shareholders over the long term. The company is still in a very good position to continue doing those buybacks because they have roughly around $2 billion, or around $1.1 billion of cash, and pretty much no long-term debt. They're in a very good position to continue doing that. Now, if I look at the company, it's trading around 11 times earnings, and this is pricing in a 10% earnings per share decline in 2025. Now, 11 times earnings to me is dirt cheap for this company. I told you should trade at 50 and 60 times earnings. Now it's trading at 11 times with the average of 25 times. I don't believe it's going to get back to 25 times, but I could easily see 15 to 16 times earnings for this company, maybe even potentially 20 times earnings someday. But 11 times earnings is very cheap for a company like that, or around a 9.5% free cash flow yield with a company that has 55% net income margins. Visa has 54%. So this company's net income margins are higher than Visa's profit margins. So they have massive profit margins, high return on capital. The management have skin in the game. They have a 45% market share of this industry, or this niche, you could say, and they've been doing amazingly well. This year is expected to be bad, around a 3.1% revenue decline. The next year is going to be much better at 12%, and you're buying it at 11 times earnings. Now, the only problem is because this operates in a cyclical industries, it's sometimes hard to know if the issues with Evolution Gaming are going to be permanent or temporary, and the company has declined quarter on quarter in terms of revenues. Now, if you don't own the stock, what I would normally do in this case, I would look at the company and I would wait for this trend to reverse. So once I start seeing another increase quarter on quarter, then I start entering the stock, because this could be the start of a major trend where every quarter is a decrease in revenues. I don't believe that's going to happen, but if I own the stock, I would personally be buying the dip, and the management are buying the dips themselves, and I believe the stock is very undervalued, pretty much on the worst case scenario. But if I didn't own the stock, if you don't want to take the risk of potentially, taking some drawdowns, I would wait for the company to increase quarter on quarter. Once I see the trend reversing, then I would enter Evolution Gaming and make it some kind of a core position. So that's how I think about the stock. I like Evolution Gaming. I like United Health. I think both of those companies are amazing quality companies that have had issues where the market believe it's permanent. I believe it's temporary. I told you why I believe it's temporary, and that's just my opinion on those stocks. I hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.